good label for the kind of strategy that you are launching is Arbitrage Plus. How is this different from a plain vanilla arbitrage fund?
Arbitrage funds have two components. One is fixed income, which is roughly 30-35%. Remaining 65 to 70% is simple cash future arbitrage. On the other hand, the hybrid SIF that we've launched allows us to have multiple components.
So in this fund, you have a set allocation towards those strategies, and how much is that?
Arbitrage and covered call put together will be roughly around.
Would it be safe to say that post expense it should be in the 8 to 10% range?
I cannot give you a number, but this
SIFs or specialized investment funds are the new buzzword in town, and there's a lot of complexity to it. Understanding it is not as straightforward as a standard mutual fund. So to help us decode all of this, we have Niranjan Avasthi, who's head of products at Edelweiss Mutual Fund. Welcome, Niranjan.
Thanks, Neil. Always great to talk to you.
Likewise. So Niranjan, let's start with the basics. So SIF, the big differentiator from a normal mutual fund is the use of derivatives, futures and options, including the option to have 25% naked short position, so selling stocks without owning them.
Yeah.
And yet, despite having these riskier vehicles, the first products that many AMCs, including what you guys are launching, are positioned as low risk rather than high risk. Could you explain how that is the case?
So let me step back and first address. Actually, I call it a myth because a lot of people, when SIF regulations started coming in, the initial gazette which talked about naked shorts and all, usage of derivatives, even when the circular came, a lot of people thought that SIF, because the word derivative included, it will be high risk, high return. But if you see derivative, the very nature of derivative is actually to hedge. The invention of derivative forward contract was done to reduce risk of price fluctuation. So the very basic quality of derivative is to reduce risk.
Right.
Later on, of course, speculators started trading into derivatives because it has another quality, which is leverage. You can take exposure to maybe 100 rupees by just paying 15 rupees. And the leverage part brings in the risk. Derivative is actually used to reduce risk, but the leverage part of derivative enhances the risk. Now we need to understand, in SIF and even in MF, leverage is not allowed. So that is the basic, and hence it will be wrong to say that whichever SIF will come to expect high risk, high return. There may be some strategy where the underlying is equity and all, and hence using the flexibility of derivatives, coming to hybrid as a strategy, what we thought is on two counts. One, there is a pure gap that we saw between fixed income funds today and hybrid funds that offer average returns with moderate risk. In the hybrid mutual fund space, you have balanced advantage fund, you have aggressive hybrid funds, you have equity savings fund, and then directly you have arbitrage fund and fixed income fund. There is nothing in between where the risks are lower, which are much closer to maybe fixed income or slightly higher, and the returns are moderate, which erstwhile tax efficient fixed income funds were able to deliver. And we thought that's a huge gap, and actually we spoke to a lot of investors over the last 2-3 months. We also had plans to launch equity and all, that's all in the plan, but basis this gap and also the need of investors, we thought this would be the right strategy to go ahead first. The second is, of course, the market conditions. We have clearly moved from a very high return zone to a moderate return zone. In these kind of situation, the risk appetite of investors usually come down. We are still waiting to come down, and generally return expectations come down, and hybrid funds usually do well in these kind of environment. So on these two counts, because of these two reasons, we thought this could be the first strategy which may suit the need of the hour and also the need of the investors.
Sure. So as I was told earlier, a good label for the kind of strategy that you are launching is Arbitrage Plus, because people are familiar with arbitrage funds, which also currently use derivatives, The strategy that they use is very simple. They buy the stocks and they sell futures, and the difference is the interest rate, which is what they get. How is this different from a plain vanilla arbitrage fund?
So let's understand arbitrage funds in a simple way. Arbitrage funds have two components. One is fixed income, which is roughly 30-35%. Remaining 65 to 70% is simple cash future arbitrage, which is a risk-free way to generate income from the spread. These are only two components in the arbitrage fund, and hence over a longer period of time or even short period of time, the return of arbitrage fund is linked to fixed income, because your arbitrage spreads are also nothing but cost of carry, which are linked to fixed income rates in the economy, and your fixed income component in which case will give you based on the interest rates in the economy. So mostly the returns are in line with fixed income, but tax efficient. On the other hand, the hybrid SIF that we have launched allows us to have multiple components. One small component is cash future arbitrage. The other component, of course, which is a large significant component, is fixed income, a mix of good quality bonds. The other two component, which with lot of flexibility is allowed in SIF, which otherwise we can't do in arbitrage or many other mutual fund, is your covered call strategy, which generates a decent return if done well with moderate risk. You can do pair trades, long short, straddle, strangle. Again, these are derivative strategies. So these two are something very different which you can't do in a normal arbitrage, right. And plus special situation, which is the open equity exposure that you can take.
Okay, so let's zoom in on both of these. First, let's talk about the option strategies. So covered call, as far as I understand it, is simply that you own the underlying stock and you sell the calls of those stocks, so that if the price goes beyond that call strike price, then your gains are capped, but in return you get a premium. So, so you get steady income. The other option strategies that you described are more complex, so where you essentially either sell a call and a put on both sides, or you sell them at the same strike price at different strike prices, essentially different versions of option strategies. So in this fund, you have a set allocation towards those strategies, and how much is that?
Yeah. So we have a set allocation while the SID is broad, but the way we wanted to position this fund where the risks are lower and returns are moderate, what we have done is we have put certain boundaries for each of these strategies. Arbitrage and covered call put together will be roughly around 20 to 40% range. Arbitrage plus covered call, because covered call is also a hedge position and your cash future arbitrage. Both these components we thought are similar in nature. Sure. That component will be roughly around 20 to 40%, max 40-45%. So that is one component. Fixed income will be roughly around 40 to 60%. This will also include margin debt that we need to purchase in lieu of the derivative positions that we have, plus core debt allocation will be included, which will be a mix of corporate bond, PSU bonds, high quality, which will give you steady accrual income. So that will be roughly 40 to 60%.
Sorry, so since you said high quality, do you have any filters that you will not go below AAA? What's the debt side?
We have said we'll operate in the space of AAA and AA. Okay. We will not get into single A and below. So clearly we won't take any credit risk calls here. Okay. Because as I said, we wanted to have a lower risk product on a relative basis, hence we will stick to that space. So again, fixed income will be, so if you put these two together, on an average 80% of the portfolio will be this. Sure. Covered call, arbitrage, fixed income. Sure. Which gives you a lot of stability, lower risk. The other two components, which we call it, would be enhancing your overall portfolio return. One bucket will be special situation, which will include IPOs, buyback offers, open offers, merger, demerger, index inclusion, exclusion. These span somewhere between 1 week to maybe 1.5 2 months kind of trade, where returns are not guaranteed, of course, but you have certain visibility. In a buyback, in an open offer, at what price you are getting into, you can hedge the risk and you can earn out of spread. IPOs, if you do a right selection on listing day gains, the idea is to get into good IPOs, get listing day gains and get out. Of course, they are not evergreen opportunities, but whenever. So, special situation is 0 to 10%. Also, why 0? Because at times when there are no special situation, this money will stay in debt. So, it is in lieu of debt, special situation whenever they are will come here. And another remaining 10 to 20% will be all these straddle, strangle, which are tactical, technical trades into options. Both these component would be overall limited to 20 odd percent on an average. So, if you see 80% you have strategy which is low on risk, aiming to generate stable income in the portfolio, and the other two strategies are opportunistic, which will enhance the overall return. And this combined together gives you, or the aim of the product is to generate return that is better, maybe couple of percentage over and above your fixed income rates.
Right. So just to recap the percentage allocation, you have approximately 40% in fixed income, 40% in arbitrage.
Arbitrage and covered call.
And covered call.
Yeah.
And the balance 20% is either special situations.
Special mix of special situation and certain derivative trades like straddle, strangle, long short, all those.
Understood. And from this additional 20%, you expect to make an alpha, right? That is where you would differentiate yourself from a pure arbitrage fund.
So, versus pure arbitrage, the alpha or the excess return, I would say, would be generated from three components. One is covered call, because that generates return much better than pure cash future arbitrage. So, covered call is there. The second component is special situation, and the third component is derivative, which is straddle, strangle and all those. So, all these three components put together on an average, if you total it out, will be roughly 40-50% of the portfolio, which is different from arbitrage.
Sure, sure. And also just to clarify, when we say that, let's say straddle, strangle and other option strategies are at some point of time, let's say they are 10% of the portfolio.
Yeah.
This we are talking about the premiums, right? So the notional exposure can be much more, can be 40-50% of the portfolio also.
No, so here the regulation is very, very clear. If you are shorting a call or if you are shorting a put, which you do in straddle, strangle, the total notional exposure is the exposure and not the premium that you are going to receive.
Okay.
So, the notional value of the contract, and hence I said there is no leverage. So, the risk of going wrong is not very high out here. So, it is not that 10% will be premium, then the notional exposure will be much higher. It is 10% is the notional exposure.
Okay, okay. So, if you have 100 rupees, you're essentially saying that you might buy an option for 1 or 2 rupees, and its underlying becomes say 8-9.
Yeah, and the remaining will sit in debt, which is margin debt. And that is where debt component will be roughly around even up to 60%, because if I am taking 10% into options, probably I will pay 2 rupees as margin, just a simple calculation, and the remaining 8 rupees I will have to keep it in debt as a margin.
How much alpha can this add? Because it's quite a small part of the portfolio.
Yeah. So, I am not talking in terms of return, but generally straddle, strangle, covered call, on an annualized basis, they have ability to generate somewhere between, based on back testing that we have seen and based on the premiums, somewhere between 10 to 15%, which is significantly higher than the fixed income component that will be in the portfolio, which could be yielding somewhere around 7.5 to 8%. But of course, these are not guaranteed or fixed returns. It comes via efficiency, it comes via proper risk management, proper due diligence of each of the position, also limits, and that is where skills come in. Also, all these strategies that we have selected, whether it is straddle, whether it is strangle, whether it is call put parity or covered call, in a way these are hedge position. These are not naked one-sided position, which we don't want to do in this strategy.
Sure. I mean, it's hedged, but not as hedged as a pure arbitrage.
Of course, these are hedged. Arbitrage is completely different. It is, so I don't want to get into technical, but there is a delta hedge, there is, beta hedge. So, these are not as risk free as a pure cash future arbitrage, but they are lower on risk. And hence I said covered call, straddle, strangle, if done well, the risks are lower because you are not taking leverage here.
Because just to isolate covered call, which is a major
Yes,
part of the
yes.
strategy, if there's a decline in the price of the underlying shares,
Yeah.
the call is not going to protect you. I mean, it's going to provide you some premium which
Yes.
you will pocket, but that's
Of
about
course.
it.
So, in sharp fall in covered call, what happens is if the stock goes up, you are giving away the upside and you are earning the premium. If stock goes below a certain certain price, you are still earning the premium. But after a certain price, the entire position will give you losses.
Yeah.
So, there are ways where you can protect the losses. One is you can either buy puts, protective puts, at the same time, and you can hedge. So, if stock goes below that, your put is protecting you.
So is that part
Giving
of your
away.
covered call strategy?
So, we may see it is not part that it is not that when we are getting into a covered call we will always buy protective put, because while doing that you are also giving away some percentage of return, but at what stage you want to hedge your risk. So, stop losses becomes very important. The other way is you can also convert that position into pure arbitrage the moment price crosses a certain limit. So, there are ways where you can protect downside, and all these things will be used, because in all these trades the aim is to, one is to protect capital and generate income. It is not to only generate capital appreciation.
Sure, sure. I'll just finish this segment by giving a summary of my understanding and tell me if yours differs. Essentially, in an SIF, you are lowering the beta risk, but you are somewhat increasing the alpha risk in the sense you are taking a very AMC focused bet rather than which way the market goes.
In a sense, when we are getting into covered call, all these kind of things.
Yes, because you're taking away the risk of the market going down if you are buying puts, for example. But I am betting on you to make sure that those derivatives calls are and that strategy turns out well.
Yeah, absolutely. As I said, even in a normal mutual fund, when a fund manager takes a call, whether it is debt or equity, it is a skill set that generates alpha. It is a skill set that generates return. Even if you want to match the benchmark return, and if you are taking an active call, it has to work, whether you being underweight a benchmark or overweight the benchmark. Same way, because it's an active fund, skills of the fund manager and the AMC will definitely have a huge role to play.
I would just go one step further and say that in the long only fund, a lot of funds are essentially, plus minus the index a little bit.
Yes.
So the risk in them at worst is you underperform the index by a few percentage points. Whereas here, because you have derivatives, it's a much bigger bet on the AMC skill.
Yes, and hence what we have done is within derivative also we are not doing naked shorts and all, because that can go in any direction if it's a one way call. If you are shorting a stock which you don't own, and if it goes down, your risks are open. At the same time, if you are doing a covered call, at least to certain extent, whether market moves up or moves down, maybe 2-3%, 4-5%, you are not getting that risk or bringing that risk in the portfolio. So, all these strategies are chosen based on the risks are lower, returns are not very high, returns are moderate. So, the overall positioning, I would say what we have tried to do is keep the return here, at the same time bring the return risk down. So, bring down the standard deviation, try to keep returns intact and that is the beauty of derivative. If you do it well, you can do that. No other strategies allow you to do that. I will give you a very simple plain vanilla example of a balanced advantage fund. Over the years, these funds have proven what they have tried to do. They have somewhere tried to match the returns of equity markets over a longer period of time, maybe capture 80-90% of equity market returns, but on the drawdowns and on the risks, they are half or less than half of what Nifty is. So, balance advantage standard deviation is 10-11%, Nifty standard deviation is 16-17%, but returns are almost 80-90% off. Same here, what we are trying to do is keep returns closer to average hybrid fund categories, but risk bring it down closer to maybe fixed income to some extent. So that's the positioning that we have tried to achieve here.
Sure.
That's the aim.
Sure. Niranjan, let's talk about where returns might fall. Maybe you cannot speak about it for your individual fund, but for for a fund that adopts this sort of strategy, Arbitrage Plus, um, would it be safe to say that post expense it should be in the 8 to 10% range?
So for the category which is trying to do all these strategies, whether it is fixed income, half of the portfolio fixed income, covered call, doing special situation, there we don't know how much the returns can come, because that is purely an active call that a fund manager would take. Straddle, strangle, which is smaller part. While I cannot give you a number, but this strategy on a post basis definitely can add maybe couple of percentage more compared to a fixed income and an arbitrage fund.
Okay, so let me rephrase that. Let's say that the arbitrage yield currently is 6%.
The gross arbitrage is around 7%. After expense it comes down to around 6%, right?
Okay. So again, speaking post expense, essentially you can potentially add 1 or 2% to this, right? And that's how you get to 8.
Absolutely. Otherwise, this kind of product won't make sense. And it's a simple calculation, because your covered call usually gives you maybe 3-4% better than your cash future arbitrage. Your fixed income is yielding you around 7.5%, a mix of that. Special situation, we don't know how much it can add, but historically in our funds, I can talk, like our equity savings fund, historically we have seen special situation can add another 1.5-2% net to the portfolio, with average 5-10% exposure, and then remaining is straddle, strangle, which is very small. So yeah, the math comes down to that. The idea is to generate couple of percentage more on a post tax basis versus what a fixed income is earning investor or arbitrage.
And with the volatility between fixed income and equity.
And equity savings, that's correct.
Okay. Now let's talk about all of the administrative points that investors should know. Number one, you can't invest below 10 lakhs.
Yes.
Number two, if you want to do an SIP, the SIP can only happen after you first put in a 10 lakh lump sum.
Yes.
Number three, you can't do an STP into the fund from a liquid fund, unlike.
Yeah, from mutual fund it is not allowed.
Right. In terms of expense ratios, what are we looking at?
So our aim is, because it's a moderate return portfolio, though it is hybrid, we will be keeping the regular expense somewhere around 1.5%, and indirect will be close to maybe 60 basis point or so.
Okay.
So slightly higher than arbitrage, because the return potential is also higher, but also much lower than a pure maybe equity savings fund as a category, or even other hybrid funds in the space.
Okay. And the minimum ticket size is at AMC level, right? So if I've put 10 lakhs into one of your strategies, I can put just 1 lakh into another one.
Yeah.
Okay. Okay.
So if we have two strategies and someone wants to invest in both the strategies, technically they can invest 5 lakh each and complete that 10 lakh.
Right.
Also, now someone invests 10 lakh in this, and there is another SIF, Altiva SIF coming in maybe couple of months down the line, and if the minimum in that is set say around 10,000, they can start with 10,000 as well, because at the AMC level 10 lakh limit they have crossed.
And they can move 5 lakhs from the existing SIF strategy.
That needs to be checked, because there could be some operational difficulties, because when you are switching out if it is exact 10 lakhs and you are switching out, and when you are switching to another fund it drops below 10 lakhs and all, so there could be some operational clarity. We are waiting for some clarity, but practically it can be done. Whatever amount you have about 10 lakhs, that also can be switched.
Okay. What is your are you open on all business days, or it's only twice a week? What?
Yeah. So the regulations allow hybrid funds to give redemption twice a week. So what we have done is we have put it Monday and Wednesday. So the expected redemption cycle is T+2. So if you redeem on Monday, you get money on Wednesday. If you redeem on Wednesday, you get money on Friday.
Obviously, if
And
there's a,
subscriptions can be daily.
obviously if there's a holiday, then that T+2
Of
gets,
course, yeah. Then it will change.
Understood. What is the exit load?
Exit load is 3 months, 0.5%. But the ideal time horizon for this product is 2 to 3 years, because of course the taxation is 12.5 after 2 years, and if anything is redeemed before that, it will be as per the tax slab rate of the investor. So ideally it is better from a tax efficiency point of view, and also from the experience point of view,
To wait at least 2 years.
2 to 3 years is the ideal time horizon.
Okay. Anything else in terms of the mechanics? Can people use the same platforms for mutual fund investments like MFU, MF Central, their distributor, any other broking platforms, or is it still being built out? Not everyone offers it.
So basically this the RTA is the same. So it will be available on all aggregator platforms. Just like mutual fund, you will be able to buy SIFs. Even on our website currently, if you see, just like any other mutual fund, you can go, and if your KYC is done, you can just go and buy the SIF and start your investing. Though the section is different because it comes under Altiva brand. But yeah, I mean, on all aggregator platform, it will be available unless someone is yet in that process, because it's these are the initial days. If someone is trying to still build and get the APIs done from the aggregators and all, otherwise it's available everywhere seamlessly.
On the distribution side, I'm told that because there is a new exam that people have to pass, that is taking time. There are not enough exam slots available. Not everyone passes, so that will take time. But on the direct platforms, there is no such barrier, right?
So investors, I mean, there is no such criteria. So investors are free to come in and invest.
Before we conclude, can you tell us more about your roadmap ahead, the other strategies that you will launch in SIF?
So roadmap is very clear. So what we will want to build SIFs in categories where we have existing capabilities, where we are good in, and where we can justify the categories. Hybrid was a natural choice because we have a separate team that runs all our hybrid funds separately. Their expertise in managing covered call, all these derivative strategies with experience sits in there, and hence we launched that. Of course, on equity side, we are looking at strategies, whether it is X top 100, because our coverage and our ability to do well in mid cap and small cap has been displayed over the years. So that is one category where we are exploring, and later on maybe equity long short. So these are a couple of categories which we are already looking at it.
Sorry, just to zoom in on these two, you said the first one is
X top 100.
beyond the top 100 stocks.
X top 100 long short.
So essentially mid and small cap.
Yeah, essentially there you can run a good mid and small or even micro cap focus strategy with some concentration built in, and you can do tactical shots whenever opportunities are available. So we want to run a true to label X top 100 strategy out there, because even in our mid cap fund today we don't actively buy large caps.
I guess the
so same we want to replicate that.
I guess the challenge there is that futures are only available in the top 200 stocks, right? So beyond that, it's hard to find liquidity.
Yeah, so in mid caps, larger mid caps, you can always do that, because the next 100 stocks are mid cap.
Yes, correct.
So half of the universe is actually mid cap there.
Yes. And the third you mentioned is equity long short.
Yeah.
How does that differ from Arbitrage Plus?
So that could be very different, because there the equity side could be long. You don't need to be hedging that. While we are in initial thoughts, but there you can actually run a fund which is slightly different, or maybe a better substitute to a flexi cap strategy, where your equity could be a concentrated equity flexi cap. Along with that, you can do some fundamental shorts. So it could be very different. So it will sit in equity risk profile. It need not be Arbitrage Plus. It may sit in equity risk profile with various other strategy, when you whether
So
you want
essentially
to,
higher risk, higher volatility.
higher, so it will match the volatility of equity strategy, I would say.
rather than
Then we can enhance it, whether you want to position it lower than equity in terms of risk and returns matching equity, or you want to have similar risk like equity and give you
Higher returns.
higher return. So a lot of possibilities are there. We are still figuring out what we can do there. And other interesting strategies, of course, the asset allocator, where you can run a very true to label multi-asset. There are no constraint. You don't have to have minimum 10% in each like you have in multi-asset mutual funds. So it's pure dynamic. So if we are working on some models and all, if we can come out with something meaningful, that is also a very interesting category.
Absolutely. Niranjan, thank you so much.
Thanks, Neil. Pleasure talking to you.
Likewise.
Thanks.